China is trying to make its stock markets more investable with serious stimulus efforts from all corners. But is it working?
This is not really the medicines at the moment that China need most. They may help just a little bit, but those are not really the key issues. The challenge in China, both the economy and the stock market overall for the broad market is still quite significant.
It's Monday, the 19th of February, and you're watching Markets with Madison. Its biggest property developer, Evergrande, has been ordered to liquidate, piling up problems for China's economy. For the past 6 months, China has tried to make its stock markets more investable, with stimulus efforts ramping up significantly so far this year. But is it the right approach? Chinese officials have promised to ramp up fiscal spending to spur economic growth, and they're coming at it from all angles. State-backed funds are buying more local shares as China's market regulator tightens the screw on short sellers. China's central bank is on team stimulus too, having just cut bank capital reserve requirements by 50 basis points, reportedly freeing up 1 trillion yuan. In July last year, the Shenzhen and Shanghai stock exchanges jointly announced measures aimed at lifting the quality of their listed companies. Since then, over 200 companies have followed through, announcing share buybacks or having key stakeholders increase their holdings, according to research by Nikkei Asia. It's thought by some analysts to all signal a policy pivot in China, while others say China's economy isn't bad enough to warrant it. What is known is that it's all done little to boost investor confidence so far. The SZSE Component Index, which is made up of 500 companies listed on the Shenzhen Stock Exchange, is down 18% in the past 6 months. Shanghai's Composite Index is down around 10%, and Hong Kong's Hang Seng is down by 16%. Shares of US-listed Chinese companies like Alibaba are on the up after the People's Bank of China announced its capital cuts. Saxo Bank's chief China strategist Redmond Wong says that suggests none of this is the right medicine for China's economy. I spoke to him from Hong Kong. Redmond Wong, thank you so much for being with us. I really appreciate it.
Thank you. Thank you.
You said at the end of last year that you thought Chinese policymakers had a lack of urgency. Do you still think that now?
I still think that in the grand strategies of the top leadership, and I think the top priority is still pretty much stability and the national security. And I think that the economy, I think the development of the economy and what's going on in the financial market, I think in their view is still pretty much, it's not good, they understand, but it's still under their control, and they think that they are working on it.
Analysts seem to have differing views on this. Some say that all of these stimulus efforts are absolutely required and that more is probably still needed, while there's others that say the state of the Chinese economy is not bad enough to warrant any of this. What do you think?
I tend to think that, it's the typical or what we usually refer to as stimulus measure. Those are very Keynesian approach like aggregate demand management, fiscal policy, or monetary policy. I tend to agree that is probably this is not really the medicines at the moment that China need most. And as if you can also refer to the Article 4 consultative paper from the IMF, the Article 4 report from the IMF, I think they also highlight is the key problem is really the decline in the productivity. And what they actually need more is market reopening the market, more market reform, and more reform in the economy. Continue what they have been doing so successfully over the last 3 decades, but seems they have slowed down on that part. So the key thing is really to push up productivity and the trend growth. It's less about aggregate demand management. They may help just a little bit, but those are not really the key issues.
So you think what the likes of the PBOC are doing with capital requirements and also what the Chinese market regulator is doing to curb short selling, that's what the Chinese economy needs more of, less fiscal spending?
No, I think all those, the PPOC or any ban on short selling, those are actually really not the most important thing. Those are really very technical. And if you can see back in 2015, and they did a lot of market intervention to boost the stock market. I mean, is they did it, they started in July and 2015, and then the market actually made a new low in August, and then it actually not has it did not even actually bottom until the first quarter, I think around January or February in 2016, so a few months later. So I think it's really you need bending the short seller is just killing the messenger. I mean, the market needs to allow them to function to find equilibrium. So the key thing is still more marketization, more reform, and back to giving more confidence to the private sector. I think one of the things the private entrepreneur are not that willing to invest at the moment. So I think those are the key issues.
So you think confidence is waning and stock markets are declining in China because of a lack of signaling about what Chinese officials and this government is going to do?
I think signaling is play a key part. I think you said you put it really where it's a very good point. And but the more underlying is still to enhance the productivity, because productivity has been declining since 2005. For over the last 20 years, for above 4% contribution to the real GDP, and to about just 2.5% contribution to the real GDP. And now I think according to IMF, ADB, and a lot of other think tanks, the estimate is actually it will further decline to 1.3, 1.5 kind of level over the next 5 to 10 years. So that's why the trend growth of the real growth of China will come down to below 4%. According to IMF, will be by 2028 will be around, I think, 3.5, 3.4%. Other think tank also talking about 3%. So it's really to change that, we need to enhance productivity, and then there had to be not just, I think at the moment the top leadership is focusing on science and technology and innovation, but in order to have innovation, just science and technology is not enough. You need the entrepreneur to implement, to put those, so to commercialize, to put those things in work, and also you need actually uh, avoid misallocation resources. Then you need the market to function. You need the private sector to do things.
Are those, Redmond, though, not longer term nice to haves for the Chinese economy? Does it not have bigger issues that it needs to solve right now, like the downturn in the property market, for example, and the potential liquidation of Evergrande?
Yeah, I think is more need to be done is actually to not to pay out, but is actually to implement the insolvency process more efficiently, and let those really not viable property company actually to go bust. But at the same time, I think what they probably will also do is let the more some of the more viable entities, especially the SOE, to take over those projects, to complete those projects, so to maintain social stability, but at the same time to clean up the mess. But one additional thing they need to do more probably is to allow home price to decline. At the moment, they still try to manage the decline. You need to allow it to decline so that they can clear the market. That go, and then you at the same time you keep some of the developer, and let them support them to continue operate, and also take over some of the project, let get them finished. But at the same time, you need to sell those, allow those units to be sold at a lower price to clear the market.
Yeah, I was going to ask you a similar question actually, not necessarily about the state of house prices, but about the state of stock markets in China overall. Should they not be allowed to correct? Because won't they naturally fall to a bottom where enough opportunistic buyers will buy in and they would help it naturally recover eventually?
I think it's slightly different from the property market. Property market, the price pretty much quite guided, and it's allowed, not really allow it to fall too much. But the stock market actually, especially for the smaller cap or medium cap, they have dropped quite a lot already. But I mean, it's too early to say whether it hit the bottom. Probably not yet, as we discussed earlier. But I think they have allowed stock prices to come down, but since they have seems to start affecting the social stability, because so many people lost money and so on. They have started to doing some kind of intervention, but I think they probably will not do at the same scale as what they did in 2015. I think in 2015, at that time they spent about 1.3 trillion RMB, and this time, I mean, some of the news wire story talking about 2 trillion, but I doubt. And this time round, and also probably they will try to manage the decline, but I don't think they will do as aggressive back in 2015.
What number would be your pick? How much do you think all of this as a rescue package will total in the end?
I think it's too early to say. I think it's that they need. I mean, in order to get it more effective, at least to try to boost the market, to keep it there for maybe for a few months and so on. Probably they need in the range of that's estimate. They probably need to about it's 3 to 5% of the market cap. So that you are talking about it's quite something like I think you're talking about between 3 trillion to 6 trillion kind of numbers, even maybe probably. And but I mean that, but I don't think they will spend that much. I think that they will. I think they will allow. It's really not their top priority. I mean, at the same time, you remember since 2017, the leadership, I mean, Xi Jinping is actually has started a deleveraging campaign in China. So I think if you heard what he has been talking about, and he wants to shake up the financial industry. For example, the new chief of CSRC actually has a strong regulatory background from the CSRC as well, not coming from the banking sector. This is the first time it's not someone coming from the banking sector to be the chief of CSRC, and but it's more initially from more on the securities regulatory side, and then also on the administrative side. So yeah, I think it's probably will be maintaining stability, but the deleveraging will continue.
Are all of these efforts so far at odds with Xi's deleveraging plan?
I think, I mean, it's like if you give a lot more hazard, and then you lend out a lot of money, or you also you I mean, if you actually you buy you do a lot of intervention, then and who is going to finance it? I mean, is it if you PBOC put money to finance it, or actually using up all the SOEs money? The SOE, if I mean, is so that is you are actually encouraging leverage again. It's boosting I mean, I would say it's speculation, but it's a boosting the financial sector and so on. I think this is not really his top concern. For him, I think for the leadership, I think they want to, I think, in fact, try to put more regulation over the financial sector. So probably more from the regulatory side, and but if it drop too much too fast, affecting stability. I think, yeah, they will do some sort of intervention, but it's not a very large scale, probably. Yeah.
Despite all of this at play within China's economy and on your stock markets, there's also this geopolitical tension, so they call it, between the US and China. Does China care, or does it have too much to think about internally at the moment?
I'm sure that they care so much. I mean, the US, the relationship is with the US is always the number one priority. Uh, for China, for the Chinese leadership. Doesn't mean that they have to be very good, but that's the number one thing they have to watch very closely. They have to target. They have to manipulate. They have to manage the relationship. That's the number one priority. Sometimes there will be confrontation because they have different goals, and they also have conflict. Some, it's in certain areas they also have different objectives. So there will be some kind of a competition or even rivalry in some areas. But at the same time, it's the number one. I mean, it's the most powerful country in the world. I mean, the US. So China's always have that the top in their mind, and so they have to manage it. And but whether so how successful is kind of take for that. I mean, it's between the two parties, and it's not easy. I mean, at the moment, I think the Chinese leadership actually under a lot of pressure. Otherwise, Xi Jinping would not have gone to the US. I mean, it's last year. I think he tried to manage it. I think it's not the time to really go to, for at least from the Chinese side, to really to escalate the rivalry. I mean, they are under a lot of pressure. The technology wise, I mean, the technology sanction or restriction, given a lot of pressure on China. And at the same time, the fragmentation of economic activities, the de-risking, reshoring, I mean, have been seeing a lot of export-oriented industry moving away from China, so moving the base to Vietnam and ASEAN countries and so on. That also has been giving a lot of pressure to the Chinese leadership.
Redmond, what do you think investors should do about all of this? Should they see these stimulus efforts as a means of boosting confidence in the Chinese stock markets and look to buy in? Or because there's more structural issues at play, like you say, with productivity, should they look to avoid it for now?
I think I think we look at it divided into three parts. I mean, for traders, I mean, when you have volatility, either from the long or short side, and also you can do a lot of things. You can make a lot of money when there's volatility. If you're a trader, so you're nimble and then react quickly to, so ride on the tide of the intervention and so on. And just like over the last 2-3 weeks, of people buying those is a large is index constituent stock or the SOE quality SOE that tend to be benefit from the intervention and so on. That's number one. And then number two is for some of the investors, they are good at stock picking. They are willing to devote the time to do the research. I mean, okay, I don't think industrial policy is the solution for China, right? But at the same time, that is what the leadership is doing. So they are trying to promote certain industries, certain technology industries, certain, not so much the e-commerce, but actually it's more on the hard technology, the advanced manufacturing, and agriculture, tech, and all those other things. So some industry will be benefited. So if for stock picker, they are willing to spend their time, or at least at the right Asia ETF, which specialize in certain industry, those are getting tailwind from industrial policy. You probably can also do make some good money. I mean, it's like over the last few months, you still have some company doing well in China, some of the stock. And then the third one, for the really longer term, more kind of board-based allocation, it's X-allocator. I'm not really interested in stock pick so much, but I'm as whether I should allocate more to China as a whole. And I think for those part of those investor, probably they can be a little bit more patient and can look for better opportunities or better level, or maybe accumulated when the market are doing not to chase the market. When the market came down, they can start reduce the underweight. But the challenge in China, that both the economy and the stock market overall for the bond market is still quite significant. So so for that part, I think I would be more cautious and will be more doing it much more slowly.
Thank you so much for your insights, Redmond. Really appreciate it.
Yeah, thank you. Thank you for having me.
The reason I cover China's economy so often is because our economy here in New Zealand is so deeply tied to it. It's our largest trading partner, so companies like Fonterra are reliant on it being revived. My take is that China will be one of the biggest macro trends to keep an eye on this year. Now go put your money to work. Thanks for watching Markets with Madison, the New Zealand Herald's show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.